Have you ever wondered how analysts figure out if a stock is a good buy? Well, it's not a crystal ball, that's for sure. It's actually a lot like a doctor giving a patient a full health checkup. And today, that's exactly what we're going to do. We're going to walk through a real-world case study and check a company's financial health, from its vital signs all the way to the final diagnosis. I mean, this is the big question, right? It's not about jumping on hot tips or just guessing. It's about a systematic process, a real evaluation, where you look for signs of strength, maybe some weaknesses, and of course, its potential for the future. So, let's begin the examination.
First things first, we need to meet our patient. For this checkup, our focus is on an Indian manufacturing company called PG Electroplast, or as we'll call it, PGEL.
So, what does PGEL actually do? Well, to put it simply, they're experts at taking raw plastic and turning it into these incredibly precise, often complex components that are essential for a ton of products that you and I use every single day. And where do all these parts end up? Well, they're critical components in the auto sector. Think dashboards, bumpers, all those interior fittings. They're also hiding inside your home appliances, everything from washing machines to air conditioners. They are a key and often totally unseen part of some major supply chains. So here's the really important part. PGEL isn't just stamping out plastic parts. They are a fundamental partner for big-name brands. Without companies like them, the whole manufacturing world for cars and appliances just wouldn't run as smoothly. All right, now that we know our patient a little better, it's time for the initial checkup. We're going to look at the top-line numbers, the company's vital signs, if you will, to get a quick snapshot of its overall health. First up, let's check the pulse. We're talking revenue growth. And PGEL's revenue shot up by a really strong 28.5% year over year. Now, just to give you some context, anything over 20% is usually considered pretty high growth. This number tells us the company is expanding fast. It's selling more, winning new customers, and grabbing more market share. That is a fantastic first sign of health. Okay, next, let's look at efficiency. This is measured by something called return on equity, or ROE, which came in at 18.5%. Think of it this way. For every $100 that shareholders have put into the company, PGEL is generating $18.50 in profit. A lot of big-time investors like Warren Buffett look for an ROE of at least 15%. So this number suggests that management isn't just growing the company, they're doing it profitably. And finally, let's check its core profitability with the operating margin, which is sitting at 12.8%. This tells us how much profit the company makes from its main business, making and selling those plastic components, before things like interest and taxes. A double-digit margin like this, it points to a really healthy, well-run business that has some solid pricing power. Okay, so the vital signs look excellent. We've got a strong pulse, good efficiency, and a healthy core business. But just like any good doctor would tell you, to get the complete picture, you've got to run some more detailed tests. So let's head to the lab. This table gives us a fantastic summary. So let's start with liquidity. The current ratio is 2.15. That means PDNL has more than $2 in short-term assets for every $1 of short-term debt. That's a great safety cushion. Next, let's look at leverage. Its debt to equity is just 0.45, meaning it's using more of its own money than debt to run the business. Another great sign of stability. We've already seen its strong profitability. And finally, look at valuation. The PE ratio is listed as attractive, and that's something we definitely need to dig into. And here's why that attractive valuation really matters. The price-to-earnings ratio, or PE, compares the company's stock price to its profits. A lower PE, like PGEL's 13.5, can be a big signal to investors that the stock might actually be a bargain compared to the profits the business is pulling in. So the lab results are in, and they confirm our initial diagnosis. This looks like a financially healthy company. But, no patient is absolutely perfect, and no company operates in a vacuum. Now we need to look at the whole prognosis by weighing its strengths against any potential risks or headwinds it might be facing. And here we can see both sides of the coin. On the bull side, the optimistic side, you've got those strong financials, huge growth opportunities with electric vehicles, and that reasonable valuation we just talked about. But then there's the bear side, the cautious side. There's a heavy dependence on the auto sector, which can go up and down. There are also risks from having just a few very large customers, volatile material prices, and of course, some pretty intense competition. We can kind of visualize these big external factors right here. The recovery in the auto industry, that's a major positive push. The huge shift to electric vehicles, that is a massive opportunity for a company like PGEL.
But hanging over all of it is the challenge of those fluctuating raw material costs, which can really squeeze profits if they're not managed well.
Okay, so we've met the patient, we've checked the vitals, we've reviewed the lab work, and we've considered the outside world. Now it's time to bring it all together for the final verdict, the doctor's complete assessment, and, of course, the recommendation. So, after this whole checkup, what's the bottom line? Well, the analysis from Web Cornucopia uses its own scoring system to put a number on a company's overall health and its potential as an investment. So, let's see the score. And there it is. PGEL gets a final score of 7.8 out of 10. Now, according to the source's method, that's a strong score. They call it proficient, which basically means it's a fundamentally sound company with a positive outlook. But a score is just a number, right? What's really driving it? This breakdown is so important. You can see the score is highest in growth prospects at an 8.5, in financial health at an 8.1. This tells us that the final verdict is really being driven by the company's awesome growth path and its solid financial footing. And hey, even the lowest score, valuation at 7.2, is still pretty darn good.
So, what does all this mean for the actual stock price? Well, analysts don't just predict one single future. They map out different possibilities. In a tough bear market, they see a floor around 485 rupees. Their most likely base case is a target of 650 rupees. But in an optimistic bull scenario where everything goes right, especially with EVs, they think the price could even hit 825 rupees. And all of this leads us to the final prescription from the source report. Based on that base case scenario, the recommendation is a buy with a target price of 650 rupees. That represents a potential 14% upside from the price at the time of the analysis. A very clear and actionable conclusion from our health checkup. So we've gone through the whole checkup, and by these metrics, PGEL is a healthy, growing company. But this brings us to what is always the most important question for any investor. See, the analysis gives you the diagnosis, but the decision to actually invest, that's always personal. The ultimate question isn't just, is this company healthy, but rather, does this specific patient, with its own unique set of strengths and risks, fit into the overall health of my own investment portfolio?